again, we'll pick whatever chair, and when Kathryn gets here, we'll get her up. All right, so as we filter up here, one of our guests was just asking about retail sales, and I was looking at the PPI numbers, and obviously we got the CPI numbers recently as well. So where do things stand, big picture, kind of looking at Fed policy in these markets? Kind of how do you see things shaking out? And I guess I'll start with you, Jim, because I know you and I have had past conversations. I think your opinion several months ago was that the Fed shouldn't be cutting as aggressively as they started off doing. Where do you see things going?
Yeah, I'm still of that opinion that, first of all, let me answer the first question. Retail sales was a little bit soft. CPI on Tuesday was a little bit soft. PPI today was a little bit soft. But those numbers, to some extent, are backward looking because we've had big events in April. We had Liberation Day on April 2nd, and then on Monday, we got the deal with China to reprieve the tariffs for 90 days. So what those numbers might be telling us is, what did the world look like before Liberation Day? And that's kind of like, I'm a big sports fan, so that's kind of like saying, what did my football team look like before my quarterback broke his leg? Well, it's a different team right now because we're in the post-Liberation Day period. The response out of the markets has been that we've seen interest rates trending higher, including today after the PPI report for the last month or so. I think that that's reflective of an opinion in the market, and I'll give you one statistic, that in April, the total amount of tariffs that was collected by the United States government was $15.6 billion. In March, it was 8.1. So $7.5 billion of extra tariffs was collected. We have about $400 billion of imported goods every month. So that means, back of the envelope, imported good prices went up by 1.7%. Who's paying that? And the expectation is we're going to pay it. The consumer's going to pay it. It's eventually going to show up in the economic data, especially in the inflation data. So yes, Tuesday's CPI, today's PPI, not surging. The attitude you're hearing from people is, hold on, just give it a month or two, and you're going to see those higher prices, and I think that that's what the bond market's trying to reflect.
Got it. Well, since Kathryn's here, I'm going to vacate the stage and let... Yes?
If you'd like. Stay if you like.
Oh, sure. Well, welcome to the stage, Kathryn. Just my question to start things off for Jim had been, with some of the a little bit softer inflation data, what does it mean for his Fed outlook and so on, and what potential impact on the markets could be. So I guess I would ask you the same.
I'm happy to be here, and Jim, thanks for kicking that off. I think you're right, and I'll add to Jim's point, which is my sense from the equity markets is because we got a deal, some sort of pause with China, that the markets are now saying, oh, we don't have to worry about the impact of tariffs that have been in place for the past month. It's a blip on the radar. In fact, that's incorrect, because when you look at the Port of Los Angeles or you look at the transit, you have boats and you have trains and you have logistical nightmares that have not yet fed through the system. So by my estimates, we are going to see some impact on imported good prices by the back end of the summer, early fall. Okay, so yes, in my opinion, the biggest thing coming into Liberation Day was a trade deal with China, unequivocally. So I think everyone agrees with that. So yes, we're moving in the right direction. It's a very good move, but we should not expect that because, as Jim referenced when I was approaching the stage, PPI and CPI and core PCE have come in okay for the month of April. That doesn't mean we're out of the woods. Okay, so that we should expect to see some move higher in prices. Now, what I would add to the conversation, which I think is very important, that I have not heard other strategists and economists talking enough about, and I'd like to hear the panelists' thoughts as well on this, which is when you look at interest coverage ratios, which is not an issue here in the United States, never has been. I'm an emerging markets analyst for the first part of my career, so that's what we look at. Interest coverage ratios mean how much of the revenues that a sovereign nation is taking in cover our interest expenses. So we do have tariffs, and I'm segueing from tariffs to the fiscal side of things, which is an atrocity. It's an atrocity. Tariffs are a nice influx of cash, and that's unequivocally been the case. It doesn't mean that's going to permanently remain so. But what we're seeing now is a fiscal deficit that's still egregious, okay, and debt levels that have to compensate for that fiscal deficit. So what I'm alluding to here is we need either lower spending or more revenues to maintain our interest coverage ratios. Interest coverage ratios means revenue over what we're paying on our debt. Now what happens is, and Jim also mentioned this as I was approaching the stage, is the bond market is potentially reflecting what's coming down the pike. So interest rates are moving higher, meaning we have to pay more cash to service our debt. And debt is moving higher. And deficits are unfortunately not getting lower. Okay? So when you look at interest coverage ratios, and this is something that I did on my team, is a year ago, fiscal deficits are still pretty ugly. So there's that. But what has happened is interest rates on our debt have moved up to such an extent that interest coverage ratios have moved from 14 months to 5 months. So that means that we have 5 months of coverage of our revenues to service the debt. No, that's not as good as 14. We can still service our debt, but the trends are bad. So when people say, and I was one of them, debt ceiling, I don't care, it's such a joke, we just kick the can every time. It's true, we do. But when you look underneath the hood, either we get our fiscal house in order, or this is not going to work out too well. So I think that the back end of the yield curve, which is the 10s, 15s, 20, 30-year treasuries, are just going to keep moving higher. In my opinion, this experiment, which is Trump 2.0, which I think is in the core a fundamental intended shift towards a smaller state of government in the role of the economy, which I applaud enthusiastically, is only successful, and here I'll close because I'm going too long, is only successful if we slash spending in a meaningful way. It's the only way, in my opinion, because otherwise, we take a fiscal deficit of 6.5%, 7% of GDP, and we make it higher. Interest coverage ratios go lower. And that's the trend. So why should we expect it to change? So DOGE has to be successful. Sorry, but we have to reform Medicare, Medicaid, and Social Security because interest payments now are at such an extent that they exceed what we pay on defense, which is a lot. So when you have the biggest 4 obligatory spending measures, mandatory, if you default on any of them, the U.S. defaults. Fiscal, Social Security, Medicare, Medicaid, interest payments. There's other stuff too, but those are the biggest things. Something's got to give, and I do think that that I applaud the tax reform bill. I think Congressman Byron Donalds, who I had a conversation with a month ago, said it's coming. He said, we're going to tackle Medicare, Medicaid. We're not gonna slash it, but we're gonna bring it to pre-COVID levels so that guys and gals that are taking advantage of the system no longer can.
Thanks, Kathryn. Ed, I want to get on that point there a little bit about, and especially I find it interesting with the emerging markets background. Temporarily, at least, we had that pattern where the U.S. dollar was selling off, U.S. Treasuries were selling off. It was sort of that almost like emerging markets pattern. Is that something we need to worry about longer term, or what are your thoughts on how things are shaking out?
I'm not particularly worried about that. Certainly not over the rest of my lifetime. Maybe the kids are going to have to worry about it. Look, I think one of the reasons we've been getting away with these deficits and mounting debt is because it's a generational theft. We're just stealing the money from the kids. We're leaving all this debt to the kids. But that's okay. They never listened to us, and we didn't like their friends, and so screw them. What the hell? On the other hand, we're going to leave them a lot of money. I think we're trying to spend it as quick as we can as we retire, but there's going to be a lot of inheritance, and there's a lot of intergenerational wealth transfers going on. My attitude towards the debt is I'll worry about it when the bond market worries about it. So I was worried for a few months there in 2023 when we went from 4 to 5% from August to October. And, Janet Yellen, Treasury Secretary on November 1st said to the bond vigilantes, well, if you don't like my bonds and notes, I won't increase them and I'll finance more in the bill market. So there's ways to keep this game going for a while. But the idea that the dollar is going to lose its stature as the international reserve currency is, in my mind, kind of ridiculous. We have the largest, deepest capital market in the world. I guess you can own gold, and that's fine. That's what central banks are doing, and that is certainly an alternative to the dollar. But I don't view the euro or the yen as particularly appealing, and recently the euro has been very strong, which is a disaster for Europe. They need a weak currency. Trump would like a weak dollar, but we don't need it. We can do just fine without a weak dollar. So I think the dollar will remain preeminent, will remain very strong. A lot of people look at the DXY index, the so-called dollar index. There's futures in it. A lot of people, it's a misleading indicator because a lot of people think it's a trade-weighted dollar. It's not. It's fixed weight. 57% of it is the euro. So all you're really looking at is you're looking at the euro-dollar relationship for the most part. The Federal Reserve puts out daily data on a weekly basis for a trade-weighted dollar, and the MSCI puts out a trade-weighted dollar, which is almost identical. And that just keeps going up. It's trending higher because the dollar remains very strong relative to emerging market currencies, and it's been kind of volatile and flat relative to developed market currencies. So I think a lot of this silly talk from going from exceptionalism to suddenly we're not exceptional is silly talk.
Thank you. We don't have a ton of time, and I want to make sure we get to questions, but I do want to briefly, you had a point that you want to bring up, Jim?
I just wanted to riff on one last thing that Ed said about, the loss of American exceptionalism. That's a bunch of salty Europeans that are just pissed off at us making that statement. That's a statement. American exceptionalism goes back to Alex Tocqueville 200 years ago, talking about the system of government. And when they say that, what they're trying to say is the country's going to cease to exist. And that's kind of a silly statement. Now, you want to say our stock market's going to go down, that's fine. You want to say our yields are going to go up, that's fine. But when you start throwing out those kind of lines, you're really telling me more about you than you're telling me about what our markets.
Everyone hates the top dog.
What's that?
Everyone hates the top dog.
Yeah.
I'm a Patriots fan. We used to be the top dog. Now we're not. Now we're not even in the club. I want to ask briefly, given this situation that we've seen in the U.S. dollar against Asian currencies, the won, the Taiwan dollar, is that part of this sort of Mar-a-Lago Accord? We're trying to balance trade by talking down the dollar. Is that a tempest in a teapot? I'm just curious on anyone's thoughts on that.
I guess I'll start with the whole idea with the Mar-a-Lago Accord. And this is kind of a preview of my presentation tomorrow. And you heard this from Ed and Kathryn a little bit too. What Trump is attempting to do needs to be done. The status quo cannot hold. We cannot continue to have $7 trillion budgets, $2 trillion deficits, run the debt up, continue to have a large trade imbalance. Now the problem with the trade imbalance, if you read some of the work, is that the idea was competitive advantage. We build stuff, we import stuff, we pay for it with dollars, the dollars get recycled back to us in terms of a capital surplus. Fine, if the dollars are going to a democratic country and it's going to private sector actors. If we're sending the money to Toyota and we're sending the money to Mitsubishi in Japan, Toyota and Mitsubishi are making decisions that's in the best interest of them. Okay, fine. But if we're sending the money to China, the Chinese companies that we're sending it to are making decisions that's in the best interest of the communist Chinese government. And that puts us at risk. So these things needed to be rebalanced. That part's right. Now maybe you don't like the radical policy that he has with tariffs. Okay, fine. Then give me another radical policy, because we're not going to go back. We're not going to go back to the status quo. And that's why I push back on a lot of the criticism. The criticism I hear is almost like, just stop with all this. Just forget it. Just go back to the way it was last year and everything will be fine. I actually think it wouldn't be. I think if Trump were to come out today and say, I changed my mind, forget these tariff things, I'm done with it, and stuff, I think the bond market would have a worse reaction, because you'd be announcing to the bond market that the supply that we're talking about is going to increase dramatically. At least now you're giving the hope that we're going to try and get our hands around it. Maybe we don't, and that's a problem for later. But if you just give up, I think the bond market would take it much worse. So that's part of what the process is. Now, the whole Mar-a-Lago Accord is something within that. Just real quick in 2 sentences. whenever there's been a major realignment of the global trading or the global economic order, it's usually been named after the resort where it's happened. Bretton Woods, which was in 1944, which set up the fixed rate dollar exchange rate, is still a resort in New Hampshire. You could go there this weekend if you wanted to and stay there. 1985, we had the Plaza Accord. That's the Plaza Hotel in New York City. The Mar-a-Lago Accord was just a riff on that. Not that there's an actual accord or there's going to be an actual meeting at Mar-a-Lago, but as a metaphor that we're in the process of majorly realigning the global economic order. And again, I would argue it needs to be. And they were just kind of riffing off of Bretton Woods and Plaza and to call it the Mar-a-Lago Accord. So all I would have to say, and I'll let Ed and Kathryn comment on it, is that I think it's a necessary thing that we need to do. Again, maybe you don't like certain aspects of the way we're doing it, fine, but you can't say, let's just forget the whole thing and go back. Give me another radical policy that we have to do.
Okay. Kathryn had one point to make, and then we probably have time for one or two questions if you have them, so please.
It reminds me of the emperor with no clothes. You know, a lot of this has been sustained, a lot of this meaning the economic exceptionalism in the past few years, by inordinate government spending. So the government, you know, I love this thing. As an economist, you have the crowding out phenomenon. The crowding out phenomenon, what it says is that the government becomes so large and sucks so much of the oxygen from the same pool of capital with which the private sector is at the same time vying for, that it pushes out the private sector, okay? And that's what's happening right now. So yes, and I agree with Ed, I completely agree. The US dollar will remain the sovereign reserve currency of the world, and it won't be Bitcoin that replaces it. Even Michael Saylor says that. Bitcoin will not replace the US dollar. Bitcoin will replace gold as a store of value. But what's happening right now is the crowding out of the private sector, okay? And what that means is that interest rates remain very high and go higher because the government needs so much funding to cover its fiscal deficits. What does that mean? That means corporations, both small and big, have to pay higher rates to take out loans and to do stuff. So they don't do it. It's crowding out of the private sector. So what has to happen here is what I think is happening. Hopefully it gains more traction, which is, you know, this 3-3-3 promise of or goal of Secretary Bessent: 3% fiscal deficit, 3% economic growth, and 3 million barrels per day additional oil supply. That sounds awesome, you know, but we got to get there. So, you know, the president has said, I'm not going to touch the entitlement programs, but at least let's start making some inroads there. And I'm not sure that we'll get to 3% fiscal deficit from 6.5%, but the truth is that what's occurring has to occur. And I do think that if we get a recession, I don't know if we talked about that before I joined the stage, but it would, in my view, were things to be done correctly, be a pretty phenomenal V shape. That's my view.
Thank you. Now is your opportunity over there. Yes, sir.
So I'd like for you guys to explain to me, the layperson, what I strong difficulties reconciling just the statements you guys gave today. I'd like for you guys to clarify for me what I see as a discrepancy between some statements that I heard today. Debt, interest, service cost, the how we are on an unsustainable path, 125% GDP to debt, with the fact that the tax reform is something that you think is good, but it's slated to cost $4 to $5 trillion, even with dynamic scoring over the next 10 years. How can you reconcile those two?
That's a really good question, and you're right. The tax reform does add to our deficit, so I wish it didn't. But what I was referring to was that it does incorporate changes to Medicare and Medicaid, reverting it back to pre-COVID levels, because at COVID you had eligibility expand. And people are currently receiving benefits that they should not be receiving. So I do think that structurally and fundamentally, for the sake of, as Ed alluded to, our children and our grandchildren, these programs are not going to exist, guys. Let's just face facts. They're not going to exist. So there is no political will. In my view, there's not going to be political will until, and I think Ed said this, until the bond market shows this is panic mode. I don't discard the possibility that eventually occurs as is in a Liz Truss moment, but I think the bond market is telling us that this is an issue. So I do think there are some improvements, but I agree with you. It's unfortunate that we see an addition to the deficit from the current tax bill. I don't know what you guys think about that.
Well, I think that the deficit outlook, the debt outlook is an unsustainable course. Everybody knows that. Everybody says that. Everybody knows and says that it's actually very easy to fix the deficit. All we've got to do is slow the increase in outlays and increase the pace at which receipts are growing. I think it's one of the reasons that Trump was so gung-ho on tariffs. He had this, what can I say, delusion that we could have tariffs, and tariffs would eliminate the individual income tax, for example. He talked about the External Revenue Service replacing the Internal Revenue Service. And I think after he kind of ran into reality here, he's kind of concluded that the most that he can probably get away with is a 10% across the board customs duty. And if that's the case, then if you're lucky, you'll get something like $300 billion out of it. And so that's okay, and nothing wrong with that on an annual basis. And the jury's still out on what the Doge boys saved, but I think it's not in the trillions. It's not 1 or 2 trillion. It's relatively small, but it's meaningful. Most estimates are $150 billion every year, so that helps the situation somewhat. But I agree with Kathryn. I mean, we need to deal with outlays. But I mean, in some ways we are. I'm 75, and when I turned 72, I had to take my Social Security, and it's taxed. Some in my younger years, I thought that it was like, it's great. They're going to send me money when I'm retired, and now that they send you the checks, it looks good, and then you realize that you're paying most of it back in taxes, especially if you're still working. I think people like Ray Dalio have been moping around that a debt crisis is around the corner. I don't know what it is about these billionaires where they get so depressed. I noticed that Steve Cohen is talking about retesting the lows in the stock market. I mean, I'd like to be depressed with $1 billion. That's kind of nice. It's like, are you trying to keep the rest of us from being billionaires? I mean, what's the deal here? But Ray may one of these days get it right. And so what's the big deal? We'll have a debt crisis. It doesn't mean that the government isn't going to pay interest and make repayments on the debt. It means we get to a yield level which scares the living daylights out of the politicians, which then they would respond to. We got to 5% in 2023, and maybe if we'd stayed there for a while, it might have gotten the attention of the politicians, but we came right back down. Look, the reality is the Treasury tomorrow or today could just finance everything with T-bills and no bonds at all. That would still leave the bond vigilantes hanging on to a lot of bonds that they could give their opinion about, but it might actually lead to a pretty substantial rally in the bond market. So there's a lot of games the government can still play to keep this thing going. I've been doing this for over 45 years, and over that entire period, the deficit was going to kill us. I did coin the phrase bond vigilantes back in 1983. I went back and reread what I'd written about them, and I said, well, the bond vigilantes are very upset about $200 billion deficits. Now we're talking about the bond vigilantes very upset about $2 trillion deficits. Let me make another point. I have a lot of accounts that manage money for wealthy people, they're private wealth managers, and every now and then in my discussions with them, they tell me, it's so hard to keep these wealthy people in the stock market. I said, what's the problem? I said, they don't trust the government. They don't like what they're seeing in the deficit. They like that they made a lot of money in the stock market, but they're very twitchy about it, and they want to cash it in. So I said, well, do they want to go into cash? I said, no, they want to go into 10-year Treasury bonds. I said, well, so there is a demand for these securities.
Yeah, sure.
People do like them, and they complain about all that debt. But guess what? Somebody's been financing all that debt for a long time, and here we are at interest rates which I think are actually normal. 4.5% is where the bond yield should be. I don't get freaked out about it. And it's, the auctions are going well. So, when we get some auctions getting all messy again the way we did in 2023, then as I promised, I'll start worrying about it. But as I said, there's ways to postpone the day of reckoning.
It's like TINA for the risk-free asset. There is no alternative to the risk-free asset. I think in essence is what we're saying.
Yeah, understood. Let's do one brief last
Just one
question.
last
Just as a
question.
reminder, we have all of these speakers. You'll have a chance to hear their full presentations. They'll be doing meet and greets out there, so I guarantee you'll have a chance to ask your question if you don't get it here.
So I have one question. So if you can compare China, Japan, and US over the last 15 years, the interest rates were lower across the board, but now US has very high interest rate compared to China or Japan. Can you explain that?
I could take a stab at it. For a long time, I characterized Japan as the world's largest nursing home operated by the mob. Now I think the world's largest nursing home is China, operated by Maoists. And mobs and Maoists don't necessarily do a very good job of efficiently operating an economy. And at the same time, I think the political forces and other forces have led to a tremendous collapse in fertility rates in Japan and China, which is why they are the world's largest nursing homes. And so there's a tremendous amount of deflation. Japan had a speculative bubble in real estate that burst and created a lot of deflation. Now the geriatric populations are leading to a lot of efforts to increase productivity in robotics, things like that. China, the same story, actually worse in many ways in terms of the geriatric population and the property bubble. So I'm watching the 10-year Chinese Treasury bond yield, and it's like, 1.66%. So it's come down, and the Japanese yield has gone up because they've been forever trying to get inflation to be above 2%, and so they're finally succeeding in that regard. But the United States, I think, is different in the sense that the demographics aren't the same issue. The property market, we had our bubble, and we're way past that. We basically had 10 years of deflation with zero interest rates as a result of that.
If I could just make a quick comment on that, about interest rates in general. We look at the stock market and we say, up is good and down is bad. And we just want it to go up because it's better. When we look